First, let's check in with Andre. Here we go.
So there's been a major change in the world of investing that just made hundreds of millions of Americans Bitcoin investors, whether they wanted to be or not. That means anyone with a 401k, mom and dad, grandpa, grandma, now all have a shared interest in Bitcoin's success. And all of that happened because a company called MicroStrategy, ticker symbol MSTR, just got added to what's called the NASDAQ 100 index, ticker symbol QQQ. Now, that's a lot of acronyms I just threw at you, but here's what it all means. Remember, an index is like a basket of stocks grouped together to track the performance of a specific market. And there's a lot of very popular indexes you've probably heard of before. There's the S&P 500 index. That's the index that tracks the top 500 companies in the US. There's the Russell 2000 that tracks the price performance of smaller sized companies. There's the Dow Jones, which is made up of 30 blue chip stable companies and many, many more. Now, by itself though, an index is not an investment. You don't technically buy an index directly because an index is just a measuring tool. Think of it as a scoreboard that tracks how certain groups of stocks are performing. Now, even though you can't directly buy an index, you can buy something that tracks the price performance of an index, which is where exchange-traded funds or ETFs come in. And when you buy shares of an ETF, you're essentially buying tiny pieces of every stock that's inside of that index. And an easy way to remember what an ETF is it's a way to invest your money into a specific theme. So these themes are created all the time, so I'll just make one up on the spot that kind of makes sense. Imagine I was like, I want my $100 bill to be invested across the top 10 best pizza companies in the world, eh? Now, I don't think that's actually a real ETF because I made it up, but if it was real, this $100 bill would be split among those 10 different pizza companies. And one of the most popular real themes has been tech stocks because they've made a lot of money for investors. So wouldn't it be cool if my $100 bill could be invested into the top 100 tech stocks? Well, it just so happens there is a way. That's a real ETF with a ticker symbol QQQ. That ETF has $327.5 billion in assets under management. There is a lot of money going into this ETF every single day. In fact, hundreds of millions of Americans buy this ETF, especially at their job, through their 401k retirement plans. Except now, there's about to be a major change. Starting December 23rd, 2024, QQQ will also include a company called MicroStrategy. And that means your money, along with millions of other people's money, will be exposed to Bitcoin. I want to explain how this is going to happen, what history shows us happens to a stock when it gets included inside of an index, and what it means for Bitcoin. So let's get into it. Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for more Bitcoin. It's about to get a little complicated, but first, let me explain how MicroStrategy got to a point where it has everyone indirectly buying Bitcoin. Now, MicroStrategy is a tech company, and in 2020, Michael Saylor, the guy who runs that company, used the company's leftover cash to buy Bitcoin. Everyone called him crazy, so here's what he did. First, he used $250 million of his company's last cash reserves to buy 21,454 Bitcoin at over $11,500 a coin. Then he raised money through what are called convertible debt offerings, borrowing $650 million in December 2020 and more in later rounds, with the promise to repay investors or let them convert the debt into MicroStrategy stock. Then he issued $500 million worth of new company stock in June 2021, selling the shares on the open market to raise cash to buy even more Bitcoin. By the way, I also want to mention that most of the stuff I'm explaining was not something the average person was doing. This was mostly for institutional investors, hedge funds, and accredited investors in some case. So if none of this makes sense to you, don't worry, it wasn't supposed to be something ordinary investors did. But it's these moves that allowed MicroStrategy to buy a lot of Bitcoin, over 439,000 Bitcoin at this point, without running out of cash. And he can still buy more Bitcoin. In fact, people refer to Michael as, quote, tapping the ATM every time he does this. I did an entire in-depth video explaining exactly how he does this, but assuming you're not gonna watch that video, the short version is, because he bought a lot of Bitcoin, as Bitcoin's price went up, so did the company's stock price, which means he could borrow even more money to buy even more Bitcoin. And when Bitcoin goes up, the stock price goes up, in some cases, by a factor of 3. And that's because MicroStrategy can do something you and I can't. It can do what's called leverage. It can borrow against its assets and its cash flow, and they can borrow a lot more money than anyone else can at extremely low interest rates, as low as 0% in some cases. And MicroStrategy's ability to do this superpower, combined with Bitcoin's price going up, is why there's what's called a premium to the net asset value. Kind of like how stocks trade not at the price they're worth today, but some multiple of their price to earnings ratio. There's an assumption that you're buying into a company's future growth. It's the same idea here, and it's that premium that allows MicroStrategy to tap the ATM, raising huge amounts of money to buy more Bitcoin. And now, his company, MicroStrategy, has been included in QQQ. It is now a part of a huge money machine. So it's like saying MicroStrategy has got another ATM that they can tap into to buy even more Bitcoin. So here's what happens now. When a company gets added to an index, some really interesting things start to happen, and here's the breakdown. First, there's a huge buying pressure. ETFs and index funds that track the NASDAQ 100 are now required to buy MicroStrategy stock to match the index. Funds like QQQ, which is one of the most popular ETFs in the world, have to add MicroStrategy to their holdings. They have to buy the stock. This means millions, if not potentially billions of dollars flowing into MicroStrategy as long as it stays in the index. This is similar to what happened when Tesla was added to the S&P 500 because after the announcement on November 16, 2020, Tesla stock went up by over 70% leading up to its official inclusion, which I think happened on December 21st, 2020. But the same story happened with Nvidia. It went up 40% when it was added to the S&P 500 index. And by the way, when gold was securitized in 2004 and SPDR launched their gold ETF, ticker symbol GLD, the price of that ETF went up from $410 a share to over $1,500 a share, which is a 359% increase over the course of 8 years or so. And when gold, GLD, the ETF, was included into other ETFs, because believe it or not, ETFs can be put inside of other ETFs, the price of gold went up again as demand from funds caused more buying pressure. So this index effect has the potential to bring millions, if not billions of dollars in buying pressure, which could send MicroStrategy's stock price much higher. And that's again, more leverage for Michael Saylor to use his ATM machine. Now, the second big thing that happens to a company when it's included in an index is the Bitcoin proxy effect. Here's where it gets really interesting. Since MicroStrategy's stock price moves in sync with Bitcoin's price, every time someone buys an ETF like QQQ, they are indirectly gaining exposure to MicroStrategy, which becomes more valuable because people are buying the index. So the stock price goes up, and they're indirectly getting exposure to Bitcoin whether they know it or not, since MicroStrategy is a Bitcoin treasury company. Now, if Bitcoin's price continues to go up, MicroStrategy's price goes up, and by extension, QQQ, the ETF's price goes up as well. And it becomes a feedback loop that's quietly bringing Bitcoin exposure to millions of people. Then of course, there's the third thing that happens, which is more subtle, but still a big one, which is legitimacy. Think about it like this. Bitcoin's been criticized for years as the magic internet money or speculative bubble. But now, with MicroStrategy being included into the NASDAQ 100, Bitcoin's getting a major stamp of approval. It's like saying Bitcoin is now part of the mainstream financial system. That is huge. It's hard to believe something's a bubble when it's been securitized and endorsed by BlackRock, the world's biggest asset manager in the world. When the president is saying he will establish a Bitcoin strategic reserve for the US, when companies like MicroStrategy are the fastest growing companies in the world, and even more companies like maybe Mara could follow because they're becoming a Bitcoin treasury company as well. And when I made my Bitcoin video about the ETFs at the beginning of this year, I said the spot Bitcoin ETF would make Bitcoin go to $100,000 a coin alone. Not immediately, but probably in the same year or relatively quickly. And that is exactly what happened. Bitcoin was securitized on January 10th of 2024. And by December 4th, 2024, it reached 100,000. And I think it's just getting started. So for me, the question now is, what happens next? One exciting thing that could happen next is if MicroStrategy gets included into the S&P 500 index. That is the biggest index of them all. It's the holy grail. And here's exactly what that would take. Starting with the basics, the market cap of MSTR needs to stay above the $14.5 billion threshold. Now, as of right now, MicroStrategy's market cap is somewhere in the $100 billion range, but it needs to be above $14.5 billion to meet this criteria. But market cap size is not the only thing. The second thing they need is something called liquidity. They need at least 50% of their shares in the public domain. In other words, they need to make sure that when index funds need to buy and sell the stock, it doesn't send the stock price into a tailspin. It has to be available enough for investors to buy and sell it. Now, criteria number 3 is profitability. And this is where things get a little tricky, because to be considered for the index, a company has to show positive earnings in its most recent quarter and positive earnings added up over the last 4 quarters. Now, MicroStrategy has struggled here with a track record of losses, but there's a game changer that just happened. If you reference my other video about MicroStrategy, I talk about something called the Financial Accounting Standards Board, or FASB, and the new accounting rules, which just took effect on December 15th, 2024, where MicroStrategy can now finally start accounting for unrealized Bitcoin gains as part of their income or their earnings. Now, if Bitcoin's price continues to go up, this could flip MicroStrategy's profitability from red to green, making them eligible to join the index. And this will be huge. Remember, the change just happened December 15th. But we're not done yet, because beyond these qualifications, there's actual people that have to decide whether it's something they want to do. It's not like a computer decides this automatically when a company meets the criteria. The S&P Dow Jones Indices Committee also has to have a say in this. They have to understand the company and how it's growing and its volatility, which is actually a feature of Bitcoin. And MicroStrategy's stock price, which obviously mirrors Bitcoin's, could be a double-edged sword for them. But that depends on the committee of people. They have to be proven that MicroStrategy can not only perform well, but also enhance the index's integrity, which means they have to see some level of stability, and they have to be convinced that Bitcoin isn't some Ponzi scheme. And President Donald Trump and his pro-crypto stance means there's a good chance that it can happen. So I'm crossing my fingers. Personally, I still have all of my MicroStrategy stock. I don't think I'll be buying more right now, but if it goes down significantly, I'll consider adding more. As long as the government prints money, the price of Bitcoin and MicroStrategy theoretically have no ceiling. Now, as more and more people come to this realization, because you shared the video with them so they can understand what's happening too, I wouldn't be surprised if one day we're gonna wake up and Bitcoin's price would go from $100,000 a coin to several hundred thousand in a matter of a really short amount of time. Sometimes it happens really slowly, and then it happens all at once. It's kind of interesting that Bitcoin has made it this far, and all those predictions 15 years ago are actually coming true. Maybe those Bitcoiners knew something all along. But I'd love to know how you feel about now becoming an indirect Bitcoin investor. As always, I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. I'd love to see you back here next week. I'll see you soon. Bye-bye.
What's up, Graham? It's Guys here, and we got a bit of a problem. As of a few hours ago, the Federal Reserve decided to cut interest rates by another 25 basis points, except this time, there is a bit of a catch. Despite the stock market, housing prices, and Bitcoin recently reaching brand new record highs, experts are beginning to warn that we've officially entered bubble territory, to the point where now there's no turning back. After all, we have seen similar valuations in 1929, 2001, 2020 before the COVID crash, and again today as people throw their hard-earned money into the most ridiculous places like Fartcoin, which is somehow up 50% in a week. It makes no sense. Anyway, with the recent rate cuts and market euphoria, it's more important than ever that we break down exactly what's going on, what the Federal Reserve just said, their warning for 2025, and what this means for you watching, because this will have a direct impact on almost everything from the stock market, housing prices, Bitcoin, and even the price of Fartcoin. Although really quick, if you appreciate the videos where I try to bring you updates like this as quickly as I can, it would mean the world to me if you hit the like button or subscribed if you haven't done that already. It helps out the entire channel, and that's all I ask. So thank you so much, and also a big thank you to Policy Genius for sponsoring today's video, but more on that later. Alright, so before we go into the biggest changes about to take place in 2025, when it comes to rate cuts, the single biggest factor is what's going on with inflation. That's because on December 11th, it was revealed that overall inflation increased by 2.7% year over year. And even though this is higher than their 2% target, it is an improvement from last year's 3.3%. And according to them, inflation isn't accelerating, it's merely just persistent. Anyway, in terms of where it's most persistent, food at home increased by 1.3%, food away from home, like restaurants, is up 3.6%, motor vehicle insurance is up almost 13%, health insurance is up 6%, and hey, at least some good news, energy is down 3.2%. On top of that, it's estimated that shelter, which has about a 1/3 weighting in the CPI calculation, accounted for more than 40% of the total increase in November, and in this case, the shelter index rose 4.7% on a 12-month basis, which by the way, is the smallest increase since February of 2022. All of this implies that as long as the Federal Reserve holds steady or manipulates the data, everything is on a bit of a downtrend. Although none of this comes even close to what we're experiencing in the stock market. Look, on the surface, someone needs to say it. This year has been absolutely incredible for every single stock market investor, unless you shorted MicroStrategy. I mean, for anyone who's been paying attention to their portfolio, this has been the best year for the S&P 500 of the century, being up more than 30%. And it doesn't even end there. If we go all the way back to the 1920s, we could see that there have only ever been 9 times where the S&P 500 has returned more than 30% in a year. But some experts are warning that you better not get used to it. Even though historically the stock market tends to see above average returns in the years following all-time highs, Warren Buffett is taking a slightly more cautious approach as he sells massive positions and sits on his largest cash pile of all time at $325 billion. And if that sounds crazy, just take a look at what's called the Buffett indicator. This measures the value of the US stock market divided by GDP, and he's previously referred to this as the best single measure of where valuations stand at any given moment. With this gauge, it's suggested that a reading of 100% is said to be fair. At 70%, stocks are a bargain price, and if it's near the 200% mark, investors are playing with fire. Yep, I think you know where I'm going with this. As you can see, we are currently trading at an above-trend price of 208%, which places this as one of the most expensive stock markets since the 1950s. Of course, these days, the Buffett indicator is said to be somewhat flawed because it doesn't take into account how lower interest rates could affect a company's valuation. But that isn't stopping experts from warning that these types of returns probably are not going to continue. For instance, one economist was quoted as saying that the stock market is in a mania that will push it higher before a potential 26% drop in 2025. However, it is important to mention that not everybody agrees with this thinking, and just because something is historically expensive doesn't mean it can't keep going higher and higher. Like, most experts have been calling for below average returns for more than a decade now. Like this Forbes article, which estimated an 80% chance of the S&P 500 being lower over the next 5 years in 2017. Safe to say that didn't happen. These days, most analysts all seem to fall within the same camp that we're probably going to see an annualized return of 0 to 7% over the next 10 years. And in the next year, JP Morgan, Goldman Sachs, and Morgan Stanley are calling for an S&P 500 at 6,500, Barclays estimates 6,600, Bank of America is coming up with an oddly specific 6,666. Make of that what you will, and Wells Fargo thinks 7,007 is possible. Although whatever happens, don't expect a straight line upwards. In fact, throughout history, most returns simply come from a few very, very good years that outweigh the very bad years. And 37% of the time, stocks see an annual return of more than 20%. This suggests that the title "average returns aren't normal, normal returns are extreme" is very true, and what we're seeing right now isn't so much reckless, it's just par for the course, even if people are getting caught up these days, again, in meme coins. And that, of course, brings me to the second topic I want to talk about: Bitcoin. In a remarkable turn of events, my thumbnail from January of 2021 finally came true when Bitcoin hit its infamous price of $100,000, which, by the way, I'm sorry to be the bearer of bad news here, but my mom recently asked me if I heard of Bitcoin and whether or not she should buy in. That's probably a top signal. I hate to say that, but, it is what it is. Anyway, even though it's currently a bit down from its all-time high, everything is lining up for Bitcoin to be pretty well positioned politically in 2025. For instance, the Trump family is openly pro-Bitcoin and could be open to a Bitcoin reserve in the next year or so. Gary Gensler is stepping down and being replaced by Bitcoin advocate Paul Atkins. And it appears as though quite a few companies are now beginning to raise money for the purposes of buying Bitcoin. For example, Riot Platforms is considering a raise of $500 million to place in Bitcoin. Both Microsoft and Amazon are considering proposals as well that would allocate 5% of their reserves into the asset. And the basketball player Scottie Pippen said that Satoshi Nakamoto came to me in a dream last night and handed me Santa's list. I saw Bitcoin next to Gates and Bezos. History's being written. Now, whether or not Scottie has supernatural future-telling dreams or is just privy to inside information is yet to be seen. But no matter what you think, Bitcoin is certainly going to be a very hot topic for 2025, and I have a feeling that many more companies will soon begin to adopt it. Although in terms of what's happening with the housing market, it's a completely different story. Alright, now before we go into Jerome Powell's latest comments and his outlook for 2025, there is one more item that we really need to talk about, and that would be housing prices. That's right, despite mortgage rates staying at their highest level in more than 20 years, home prices have continued to grow, with the average home rising 5.9% since December of last year. Of course, in terms of growth towards the end of this year, a lot of analysts were saying that home buyers were waiting on the sidelines until after elections. Well, now that elections are over, it's said that we've started to see signs that home buyer demand is coming back. That could lead to increased competition in coming months, possibly pushing prices higher unless we see a major spike in the number of homes being listed. In terms of which housing markets are seeing the biggest increases, we gotta give it up to Detroit, Michigan, with more than a 15% gain year over year, followed by Chicago at 13.5%, Newark at 11%, and Cleveland at 10%, with the hardest hit being Austin and San Antonio, Texas, having fallen 3 to 4.5% over the last 12 months. Although in terms of the future outlook of housing prices, Zillow has made a few of their own predictions, and surprisingly, they're all pretty reasonable. First, they think that the housing market's going to pick up, with prices rising another 2.6% within the next 12 months. This suggests that home prices may simply rise alongside inflation, which has been the trend for over 100 years. After all, if home prices rise by 5%, but inflation also rises by 5%, your equity is simply holding value, and I have a feeling this will continue to be the case. Second, expect mortgage rates to remain a bit volatile. Since home interest rates are generally tied to the value of the 10-year treasury, there tends to be a lot more speculation here than, let's say, credit card interest rates. So as a result, there could be a lot more fluctuation over the next year. Third, more of the United States will become a buyer's market as inventory gets listed. In terms of where this is going to happen, Zillow thinks that the Southwest will become the hotspot for affordability and negotiations. Fourth, they've pointed out that smaller homes are now becoming more common. In this case, builders are realizing that it's no longer profitable to maximize square footage when their buyers are just strapped for cash. So as a result, they're building less and they're passing some of the savings on to you. On top of that, more than a third of builders said that they built smaller homes in 2023, and more than a quarter plan to construct even smaller this year. And finally, fifth, rent concessions will end. In their mind, an apartment construction boom meant that landlords were competing with one another to try to get tenants. But now that almost all of those units are leased, competition is going to increase now that there's less to pick from. Now, honestly, from my perspective, just anecdotally, I am seeing a lot of sellers list their homes at exorbitant prices just to see what they could get. And on a lot of listings that I'm following, I am seeing consistent price reductions as they slowly come back down to reality. But everyone else is simply asking a very high price just for the sake of seeing what they could get. And this provides a unique opportunity for a buyer who's willing to negotiate. Although in terms of what Jerome Powell just said as of a few hours ago, and the reaction of the market, here is what you came for. As of a few hours ago, the Federal Reserve has decided to cut interest rates another 25 basis points as expected, except this time we get the benefit of receiving a lot more information about their plan for the next year in what's called the Summary of Economic Projections. This estimates where they believe we'll see inflation, interest rates, unemployment, and GDP over the next few years. And in this case, bad news, they're now expecting significantly fewer rate cuts in 2025 than they initially expected, as you can see here, which has caused the market to enter a bit of a free fall as investors price in higher rates for longer. For them, they explain that they want to take it slow, make sure that inflation doesn't re-accelerate, and by holding firm, they're ensuring that prices don't meaningfully spike back up. On top of that, they believe that we'll be able to return the inflation rate back to their 2% target and then hold steady and adjust in the future as needed. And overall, it appears as though their fight against inflation is working. All in all, none of this is too shocking. All of this was somewhat as expected, except with a few extra details sprinkled in. And if history shows us anything, it's that the Federal Reserve does move a little bit more cautiously and slowly than people expect, but eventually they're probably going to get the job done. Now, I do have to mention that in the last meeting, he was asked if he would step down if Trump wanted him to, and his response was no, because that's not permitted under law.
If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
So of course, leading up to today's meeting, Trump preemptively made the comment that he would not try to remove Jerome Powell. So hey, for the time being, it looks like we're getting more of the same. Now, as far as my own thoughts about everything discussed, in terms of the stock market, even though it is expensive, relatively speaking, based on history, at the end of the day, no one has any clue what's going to happen. And no one has any idea what the price is going to be a year from now. That's why I like to take the approach of prepare for the worst, but hope for the best, prepare for the worst. That one. This means I diversify my money throughout a variety of index funds. I do not buy individual stocks. I keep a little cash on the sidelines just in case, and I keep buying in on a regular basis regardless of the price because you know the saying, the market could remain irrational longer than you could remain solvent. Look, I know I always give the same boring advice at the end of every single video, but the truth is the boring strategy works, and I've been saying the same thing in 2017, 18, 19, all the way through today. If you would have followed this over the last 8 years, you'd be up over 200%. Now sure, that's certainly not as much as Bitcoin's 9,000% return in that time frame, but that's why I believe a well-diversified portfolio is worth it. I like placing a small amount of Bitcoin in something like an ETF, where if it goes up, great, and if it doesn't, that would really suck, but it's not the end of the world. So even though, yes, markets are high, I'm not deterred by the price, and I'm just buying in on a consistent basis, no matter what. Like, I remember making similar videos addressing the market all-time high 6 years ago, and we'll continually hit new all-time highs as the market and economy grows, hopefully. I'm just a firm believer of taking a very slow and steady approach that's very consistent, and no matter what, hitting the like button and subscribing if you have not done that already. So thank you guys so much for watching. It really means a lot. Happy New Year, happy holidays, and until next time.
Okay, everybody ready? I think we're gonna take a lot of notes on this one.
Hey everybody, welcome back to Whiteboard Finance. In today's video, I wanna show you how I'll be investing for 2025. So I'm gonna give you a big breakdown here. I usually don't have stuff on this side of the whiteboard, but it's gonna be there the whole video, and I'll give you more information on this side as we go. But basically, it's the end of the year, holidays are starting, so I wanna give you guys a perspective of how I'm looking at things and how I'll be investing my money in 2025 and moving forward. Stay tuned. Okay, so let me start this video by breaking down the things that I'll be investing in by asset class, and then we'll break down each asset class as we go. So if this is a pie, I've given this analogy 8 million times throughout the 7-8 years that I've been on YouTube. Basically, you want your pie to be representative of your net worth. Think of it like a pizza, think of it like an actual pie. Each slice is an asset class, and each asset class, you give a percentage or a weight in your portfolio. So say for easy numbers, your net worth is $100,000, you want a certain percentage allocated to each asset. That way you know if you're overweight or underweight, and you can rebalance much easier that way. So with this, let's start with stocks. So I want stocks to be basically a third of my net worth. So we're shooting for 33%. And again, I'll break that down as we go throughout the video. Next is real estate, another third, 33%. It's been a great inflation hedge over basically the last 100 years or so. And then we have Bitcoin at 15%, cash at 15%, and then we have precious metals and collectibles at 4%. So now that you understand the big bird's eye view of how I'm investing by asset class, let's break these down. Okay, so let's break down the stocks portion of my investment plan for 2025. So if you guys know me, first and foremost, I'm typically a dollar cost average investor. So if you don't know what dollar cost averaging is, it's basically just investing a certain amount of money at a certain interval for an extended period of time. So as we both know, the market goes up and down, and you want to end up somewhere in the middle if you dollar cost average, hoping that the chart goes up and to the right as it has done in the past. So what I'm doing right now is to break down my biggest position. I'm not going to share every single thing that I invest in, but just so you know, VTI, which is Vanguard's total stock market fund, is basically 53% of every single one of my portfolios, okay? So out of everything that I hold, VTI makes up more than half of it. The thing that I do want to highlight though is small cap and mid cap, but specifically small cap value. So I've been buying AVUV for a number of years now, and it's done very well for me. So the reason for that is because if you look at this chart right here, you can see that small cap has actually outperformed mid cap and also the S&P 500. You can take a look at that because for nearly 2 years, market leadership has typically been dominated by the Magnificent Seven. If you look at any fund like a VTI or the S&P 500 or any of these big funds that buy mega cap companies, they're all dominated by the biggest market cap because they're weighted towards market cap. So market cap is simply just the stock price times the shares outstanding, and that gives you the market cap or the entire value of the company. So if you look at any of these funds like VTI, for example, they're just loaded by the Magnificent Seven. These are your Googles, Metas, Teslas, things like that. NVIDIA, for example. So what I wanna do is I wanna load up a little bit more on small cap and small cap value just because they simply have much more upside to run, in my humble opinion. And then also what I'm doing is, and if you guys don't know my investment philosophy, it's typically more like a barbell philosophy. So on one end of the barbell, you have super conservative investments. That's why we have cash right here, and then really nothing in the middle, and then super risky stuff on the other side, which is why we have Bitcoin, and then the next thing I'm gonna talk about right now. So I actually bought a couple weeks ago a MicroStrategy December 19th, 2025 call option. I paid $19,100 for that one contract. If you don't know what options contracts are, they allow you to control 100 shares of the underlying asset. So my strike price is 400 and my break even is 591 a share. And we have about 365 days to get there, okay? So that's kind of my more risky equity position. And then I still have your usual suspects. I still hold a bunch of SCHD. It's one of the biggest holdings in my portfolio. I have a little bit of SPY in my Roth and things like that. So with all that being said, that's pretty much how I'm going to continue investing into 2025. It's going to be dollar cost averaging into my core holdings such as VTI, AVUV, SCHD, with a little bit more spiciness on the craps table of MicroStrategy. So that's either gonna age like a fine Montenegrin wine or it's gonna age like milk. And you guys know me, I've always been transparent with you, so I'll let you know. Okay, so number 2 is real estate. So this is supposed to be 33% of my pie. If you can see right here, 33%. Realistically, it's about 31% at the time of this recording, so I'm basically right on track. That's the beauty of weighing your asset classes. You know exactly where you stand and you can rebalance at any time. With real estate, it's a little bit harder because my house is paid off, so I do have a lot of equity in my home, other than property taxes and bills and maintenance, which never go away. Don't you just love home ownership? So even with the paid off house, you're just renting from your municipality in the form of property taxes. That will never go away. Stop paying your property taxes and see who really owns your house. But on a side note, my house is paid off. The reason I did that is because I went into psycho dad mode. I have 2 kids. I don't want any debt. Mathematically, it was dumb. Financially and peace of mind, it's fine because it allows me to be more risky in these other areas of my pie, right? When you're taking on a mortgage or low fixed rate debt, you are effectively making a hedge against the US dollar, okay? You're saying, hey, I'm gonna borrow as much money on year 0 as possible and pay it off over time when inflation is paying off my debt for me, right? So you can do the calculator. I have a home affordability spreadsheet if you're interested. You'll see how much you can pay in interest over the lifetime of the loan, but if you're keeping up with inflation, which real estate has historically done, you should be good. That's the reason why I paid off my house. For me, it's just a glorified savings account, and it's a place that I live and raise a family. It's not an investment. So if you wanna do investments, you have REITs and you have rentals, right? So I still buy VNQ, I dollar cost average into it. It's done very poorly just because the interest rate environment that we're in has been absolutely insane. It's super high. So when rates are high, it's typically not good for real estate developers or commercial real estate in general. So keep that in mind. That's an option if you wanna track an ETF of REITs, okay? Rentals. So I don't see myself buying a rental in 2025. I already went down that rabbit hole many years ago. We bought a defunct development back from PNC for just over $1 million when I worked in commercial real estate. The builder basically went belly up in 07, 08, had hundreds of unfinished lots, and we basically started building spec homes. We were selling single family homes. We were building duplexes to rent out. We did all that stuff, okay? We got rid of all those in about 2016, 2017. Obviously too early, but still made money. It is what it is. So for me personally, I don't see a rental property being on the cards, so I'm not going to be doing that for 2025. But again, my net worth between my home equity and all the other real estate proxies that I own, I'm pretty much happy with where I sit at 31% of my net worth. Okay, so moving on to number 3, cash. Cash is 15% of my net worth. At the time of this recording, it's about 13%. So right on track there as well. So where's my cash going right now? So in Robinhood Gold, I'm earning 4.25%. I have some in M1 Finance earning 4%. And then also Capital One, who I've been with for years, 3.8%. Obviously the rate cuts have affected that. This used to be at like 5, this was 5, and this was like 4.5 or 4 and some change. So T-bills right now are currently yielding 4.3%. I don't see myself buying T-bills. The reason for that is because you're locking your money up for a period of time. Yes, you can trade T-bills, but that kind of defeats the purpose of them. So even after tax and stuff like that, you're not really earning 4.3%. After tax on these, you're not really earning these rates either. That's why I wanted to talk about municipal bonds. So if you're in the highest tax bracket, municipal bonds are similar. They have similar rates as T-bills and some of the other solutions out there like CDs and bonds and things like that. But they typically pay interest income that is exempt from federal taxes. So they may also be exempt from like state income taxes if purchased from the home state. So if you're in a high tax bracket, just the tax savings alone is gonna juice these municipal bond rates up to like 6 or 7% at the time of this recording. You have to realize you're paying taxes, you're paying 1099 interest on all these right here. So you're not really yielding that rate. So when you look at inflation and you look at municipal bonds, for the people that are in the higher tax bracket watching this video, that could be an option for you. I was at the barber shop the other day, sitting next to an old commercial real estate investor that I know. He's just casually pulling up his Fidelity account, and it had a couple commas in there, okay? And there's some numbers before the first comma, right? Indicating, you know, deca millionaire. So we got to talking, and he said, you know, most of my stuff is just in real estate and municipal bonds. So that's something you may want to look into if you're in a higher tax bracket. Okay, so number 4 is everybody's favorite, Bitcoin. So Bitcoin right now, the target has always been 15% of my net worth for years, but right now I'm actually overweight at 22% of my net worth. If you count the MicroStrategy that I hold and some other Bitcoin proxies or Bitcoin related equities, it's actually higher than 22%. So I'm just dollar cost averaging. I'm never selling, okay? The reason I'm never selling, because to me, this is something that is, how do I explain this? It's either generational wealth or significantly less than what I own it for, right? There's no in between. It's just a huge asymmetric bet, and I don't need the fiat right now. I don't need the fiat US dollars at this point. So I'm just holding on to it. It's up about 125% year to date if you've been paying attention. If you haven't watched my many YouTube videos, you may want to check out the last one I did in my $100,000 Bitcoin journey. Those have all the books you need to know to read about Bitcoin if you still don't understand it yet. So the reason why I'm not selling is basically because there's too many positive catalysts right now when it comes to government and things like that. So essentially, in a nutshell, for the sake of this video, all the headwinds have become tailwinds, in my opinion. So I personally use River. This is not a sponsored video. If you want to get some Bitcoin from River, check out the link below. I dollar cost average literally every day. I buy Bitcoin literally every day, and I smash buy it on the dips. I had limit orders down to $10,000 when Bitcoin was trading at 16K, okay? It's close to $100,000 right now. So it's just one of those things that you have to study. If you don't get it, you think I'm an idiot. If you get it, it's the smartest thing on this list. Okay, so number 5 is precious metals and collectibles. So precious metals and collectibles, I shoot for about 4% of my net worth. Right now, if I had to guess, it's probably somewhere around maybe 1.5% to 2%. I would like to start increasing my gold stack. So this is not all of my gold, just because I don't want to bring it down here. But these are gold ounces, gold ounce coins that I bought from JM Bullion. If you guys are looking for a place to buy precious metals, which I'm going to talk about more here, check out JM Bullion. I've been buying from them for years. Look, you can see all these receipts. I've been buying from them for 8, 9, 10 years now at least. So basically, when you look at precious metals, it's a good hedge against inflation. Gold is actually trading at all-time highs right now as we speak. And the reason for that is because of monetary debasement. The governments are printing fiat currency like crazy. Why do you think Bitcoin's exploding? Why do you think precious metals are exploding? Why do you think I even have this as part of my net worth? So check out JM Bullion if you haven't. They're beautiful, and you can pass them down to your kids or grandkids one day. Also, if you check out other types of collectibles, you have trading cards, right? You got LeBron James rookie, Kobe Bryant rookie, Giannis Antetokounmpo rookie, Luka Doncic rookie. Should have bought a Nikola Jokic rookie, but that's a conversation for a different video. Best center of all time. A lot of people are not gonna like that, but it is what it is. So some people buy trading cards, some people buy Pokemon cards, some people buy precious metals, cars, watches. Some watches increase with value over time. Cars do increase with value over time. I know a lot of listeners probably don't wanna hear that, but if it's not your daily driver and it's an internal combustion engine 911 stick shift Porsche, it's gonna go up in value, trust me. Especially with self-driving, electrical vehicles, government mandates, people are gonna pay out the nose 20, 30, 40 years from now for a stick shift internal combustion engine sports car, trust me. Sold all my silver. Here's a tweet from 2020 saying me ready to unload my physical silver, July of 2020. And here's July of 2024, selling 100 ounces of silver at $31 an ounce, put it straight back into Bitcoin. Silver stagnating, Bitcoin went through the moon, right? Great trade. So with all this being said, I appreciate you guys watching. I wanna give you my thoughts. Stay tuned right now. Okay, so let's get into my thoughts. So some people say diversification is diversification. Some people are saying, why wouldn't I just keep investing in XYZ that has done very well for me over the years? And I actually agree to that to an extent. So if you're a business owner, or if you're someone who runs a specialty, say you're the world's best woodworker, the world's best metal worker, the world's best auto mechanic, the world's best restaurateur, right? Or commercial real estate investor, doesn't matter. Yes, you probably should have all your eggs in one basket, okay? I'll be honest there, because the ROI that you're gonna get from running a profitable business is probably gonna beat any of this right here. What I'm trying to help you do is, if you are someone who's just, you know, earning US dollars in a job, or earning a wage, or a salary worker, someone who just wants to invest soundly and not have to worry about side hustles, driving for Uber, doing all these million things that you don't wanna do, this is probably a good way to go, right? So for me, diversification actually leads to this, sleep well at night, so SWAN. I sleep well at night knowing that if any of these assets went to zero, I'm not gonna go jump off a building, right? I saw so many people after 07, 08 that literally drank themselves to death, jumped off their own buildings, killed themselves. You see it happen all the time. People blow up their portfolios, their real estate goes belly up, and that was their whole life and their whole identity was tied to that one thing, okay? Is it really worth it? No. So I'm not trying to be morbid or weird, but it's true. Some people are so obsessed with money and what money brings them and the allure and the prestige and their ego and all that stuff that they end up killing themselves over what? Some digital pixels on a screen, right? It's not worth it. So with me, I sleep well at night. If Bitcoin goes to zero, great. There goes 22% of my net worth, I don't care. Stocks go to zero, great, doesn't matter. Real estate zero, great, doesn't matter. I don't care. I'm not that invested in any one of these things where if someone comes and steals this gold, no big deal, okay, whatever. Life's too precious to tie yourself to a monetary amount. And then barbell. So the reason I want to bring up barbell is because some people think, oh, you're crazy, this is way too much of your net worth in Bitcoin. Oh, you're crazy, this is way too much of your net worth in cash. This isn't risky enough, this is too risky, this is whatever. It doesn't matter. So for me, I think that the irony is that Bitcoin is gonna move from the risky side of the barbell and the volatile side of the barbell to actually one of the safer things in the future. That may or may not happen. You may think I'm crazy, but I don't think I am. So the barbell for me is kind of how I live my life. So my wife has a W-2 job. She does well for herself, but she also has time to raise our kids, and she also provides the health insurance and does all that stuff. So she's the stability. I'm an entrepreneur. I run a couple businesses. My income is like this. It's all over the place. However, we're hitting singles, doubles, triples, in the park home runs, grand slams, and then hers is singles and doubles like this, right? So we have a foundation and a base. So that's why I barbell invest. That's why I have a sleep well at night portfolio, and that's why I diversify. And if my lifestyle or outlook on life is similar to yours, maybe you should give this allocation a try. But again, this is not financial advice. I'm just a random guy on YouTube. Don't listen to me. I haven't been studying money and geopolitics for 19 years. I have no idea what Bitcoin is. I'm just talking out of my rear end. Thank you so much for watching, and have a prosperous day.